for lack of a better term, play stupid games, win stupid prizes. The IRS, my friends, they are slow, but they are not stupid. Because when they catch up to you, not only are we looking at failure to pay penalties, if you file late, we're looking at failure to file penalties. You're going to be looking at these accuracy related penalties as well if you have been negligent or disregarded the rules or regulations, and you're going to get smacked with this penalty. And yes, I use the word smack intentionally.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Hey, family. I am excited to do this episode, but before I get into it, for all of my listeners in the Kentuckiana area, happy Derby week. You all know we shut down as a city, as a state this week, all for the Kentucky Derby. So I hope this weekend you get to enjoy time with family, friends, get a good plate of something. If you bet, win big, have fun responsibly. I just wanted to get that out of the way. Happy Derby week. So because the week is so crazy, I'm like in studio, but out of studio because I'm recording, but not with the typical setup. So if we have any type of technical sound issues, excuse me in advance. Okay. This episode, and again, I know you guys don't get as excited about taxes as me, but this episode is going to be pretty exciting because we have a very, very, very relevant tax case that is actually being petitioned in the tax court right now that deals with what we're going to talk about. So in today's episode, I'm going to go over the accuracy related penalty, and it's under Internal Revenue Code section 662. So I'm going to break down what it is. I'm going to tell you how you can have this penalty issued against you. And last but not least, let's talk about how to avoid that bad boy, okay? And when I talk about how to avoid it, that's when we're going to pull in the case I mentioned with Mrs. Beyonce Knowles-Carter versus U.S. Tax Court. Now, before you all come saying I'm being a hater, all that, once your case reaches the U.S. Tax Court, because that is a petition and certain things, part of the Taxpayer Privacy Act goes out the window, and it becomes information that anybody in the public can find. So the information that I shared today, do I have some kind of exclusive scoop? No, but I know how to read the documents, and I'm going to translate it for you and tell you why she's in this situation. Well, explain part of it from a tax standpoint, okay? So let's get to it because we only got 15 minutes. So number one, an accuracy-related penalty applies if you underpay the tax required to be shown on your return, okay? Now, there are two common accuracy-related penalties for individuals. Okay, number one, negligence or disregard of the rules or regulations. Number two is substantial understatement of income tax. Now, for those of you that are like, Timalyn, you went straight to tax and ease. What in the world does that mean? This is it. Negligence is when you don't make a reasonable attempt to follow the tax laws when you prepare your tax return. Disregard means you carelessly, recklessly, or intentionally ignore the tax rules or regulations. So let's look at some examples of negligence. This is not keeping records to prove you qualify for the credits or deductions you claim. Let's look at an example that I see often, okay? When you claim a child on a tax return, you have to be able to do what? Substantiate that. Now, if you didn't know that, that means either you're new to the podcast or you miss every other episode. Because I tell you all the time, you have to be able to substantiate anything you claim on your tax return. So with a child, what does that look like? You need to be able to produce a birth certificate. Now, do you need to give that to your tax professional every year if you pay somebody? No. But they need to, on their end, make sure they're doing their due diligence to make sure that the child actually belongs to you. Another way, we need a statement from a medical provider or daycare, something like that, an independent third party to show that you are the guardian of that child. All right. Remember, anything you're using to substantiate an expense, whether it be a deduction, credit, we need third party documentation. Another example of negligence is not including income on your tax return that was shown in an information return. Information returns are things like W-2s or 1099s. So if you file your tax return and you leave 2 W-2s off, you are being negligent. Get ready because the penalty is coming. Last example I'm going to share, not checking the accuracy of a deduction or credit that seems too good to be true. Now, I know you all have been seeing all the ads and hearing them too about the employer tax credit. You can get up to $26,000 for each employee. Now, some of you all are going out here trying to get this credit, knowing good and well you didn't have any employees you paid wages to. Now, why would you take a call about that credit if you know you didn't have any employees? That there is negligence and disregard of the rules and regulations because you're still trying to get that $26,000 even though you know you don't qualify for that credit. Got it? Good. Let's look at the substantial understatement of income tax penalty. For individuals, this tax applies if you understate your tax liability by 10% of the tax required to be shown on your tax return or $5,000, whichever is greater. So let's say that your tax liability should have been $80,000, you only have 70. Get ready because the substantial understatement of income tax penalty is coming. Now, if you claim a section of 199A qualified business income deduction on your tax return, so for my business owners, that is the QBI deduction that we will have under the Tax Cut and Job Act until 2025. You get roughly 20% of your net profit as a deduction. The penalty applies if you understate your tax liability by 5% of the tax required to be shown on your return or $5,000, whichever is greater. So let's check this out. First of all, you need to make sure you're not claiming anything that you shouldn't on your tax return. Second of all, you need to make sure that you're claiming all income that you need to on your tax return. If you received unemployment income, make sure it gets on the tax return. If you know you had sales, but they didn't send you a 1099, you know that income still belongs on the tax return. Go ahead and put it there. Okay. For lack of a better term, play stupid games, win stupid prizes. The IRS, my friends, they are slow, but they are not stupid. Because when they catch up to you, not only are we looking at failure to pay penalties, if you file late, we're looking at failure to file penalties. You're going to be looking at these accuracy related penalties as well if you have been negligent or disregarded the rules or regulations, and you're going to get smacked with this penalty. And yes, I use the word smack intentionally. So you will know that you owe the penalty because the IRS will send you a notice to let you know. Now, I've talked about failure to file penalties in many, many, many episodes, but just as a quick reminder, failure to file penalty can be up to 25% of the tax that you owed. Okay. That's a lot. So let's say that you owe $10,000 file the return 5 months late, not only are you going to owe that $10,000, you're going to owe interest on top of that. You're going to also owe a $2,500 failure to file penalty. All right. So now we're looking at a balance of around $13,000, and that's penalty, interest, tax. Right. For this penalty, check this out. Check this out. In cases of negligence or disregard of the rules or regulations, the accuracy-related penalty is 20% of the portion of the underpayment of tax that happened because of negligence or disregard. Okay? It's the same for substantial understatement. So let me say it again. Is it 20% of the actual tax that you owe? No. But it's 20% of the portion of the underpayment of tax that happened because of your negligence or disregard. So whatever your tax amount is that you left off, 20% of that is what your penalty is going to be. And please believe, just like any other penalty or liability, they're going to charge you interest on this as well. The date that they're going to start charging the interest is going to vary, as it does with certain type of penalties. But believe me, they're going to get you with that interest too. Now, if you're able to show that, you weren't actually being negligent, you weren't actually disregarding the law, there is potential to have this penalty removed or reduced. Now, I've done a whole episode on first-time penalty abatement. Go back and check that out. I did a whole episode on reasonable cause abatement. Go back and check that out if you're interested in learning about how to remove this penalty. Now, the burden of proof is going to be on you to remove or reduce this. So, if you can prove that you acted in good faith and can show reasonable cause for why you weren't able to meet your tax obligations, why you didn't include certain income, or we have instances where, some employers, they're just late getting to the game and issuing documentation. Maybe that's the case for you, and you didn't get that W-2 on time, so you left that $32,000 off your tax return. I can't even make that sound good saying it out loud. If you leave off a $32,000 W-2, but just giving that as an example. So the burden of proof would be on you to show that you filed your taxes, but that employer had not actually issued the W-2 yet. And the way you would do this, when employers issue W-2s to employees, they also have to send a copy to the IRS. So the IRS would be able to see when they actually got that W-2 and then when you filed your return. Okay? Now, like I say, this podcast is free. YouTube is free. For right now, the blog is free. If that's you and you want to learn more about that, check out those resources because they're all free. But if you want to actually work with me and me do it, that is going to cost you. However, you can still book a consultation at bowenstaxsolutions.com and we can have a phone conversation about your game plan on how to get that removed. So let's talk about how to avoid it, right? Because that's why we're here. You need to be able to substantiate every single thing that you have on the tax return. If something is missing from the tax return, you need to be able to substantiate why it shouldn't be there. Now, what does that mean? Sometimes as a business owner, you may receive a 1099, but your bottom line, you didn't actually make that money. So you may not have reported it correctly. You still need to make sure on your return it's showing the information as income from a 1099, but then because you have listened to this podcast, you have all of your information to substantiate your deductions. You're going to have all your deductions there, and then we'll see the bottom line wasn't a profit, right? You don't just leave off the 1099 because you didn't make a profit in your business, okay? Next, let's look at Miss Knowles-Carter versus Commissioner. For the tax year 2018, there is a deficiency, which means an amount of tax that was not on the return of $850,000. So $805,850. Under Internal Revenue Code Section 662A, there is an accuracy related penalty of $161,170. Wow. All right. 2019, we have a deficiency of almost $1.5 million. If you like exact numbers like I do, it was $1,442. I'm sorry, let me go back. 1,442. Why am I not being able to read this, you guys? Look, I'm going to say the numbers individually, then I'll let y'all do it. So we got one. So we got 1 million. We have $442,747. Okay. Under Internal Revenue Code Section 662A, the accuracy related penalty is $288,549. Now, as I mentioned before, this is information available to the public because we have a tax petition. From the previous 2 episodes, I talked about the appeals process with the IRS. Just because the IRS says something, that doesn't mean you have to agree with it. And under your taxpayer rights, you have the right to appeal that. In the matter of this case, the appeals process has been followed, but Ms. Knowles-Carter's team did not agree with it. And that's why we have the petition to the tax court. And that is why now part of this information is public. Okay. So as we're looking at everything, the IRS came back and said, hey, on your Schedule E3 in 2018, you failed to report income of $1,449. Not a big deal, right? But then they go through other schedules and things. And for example, on Schedule C7, we have a deduction of $761,455. That was disallowed. Now, typically when an expense is disallowed, that means 1, it was either not ordinary or necessary for the business, or 2, they couldn't substantiate it. You want to make sure any deduction you have on here is both ordinary and necessary. And then you have records to show that you actually paid for it. For example, if you buy supplies from Walmart, you need to keep the receipts. Bank statements aren't going to be enough. Because if I see you bought something from Walmart, well, shoot, you can buy anything at Walmart, right? It may not actually be tax related. So if you don't want to be in a situation where you get this humongous tax bill and you're trying to take it to the tax court, you need to make sure that you have substantiated all of your deductions and credits. And listen, I'm not picking on her, but this is a very interesting case and it is very relevant because maybe your new tax bill isn't to the tune of 2.7 million. But I see this happen almost literally every day. Taxpayers end up with a tax bill they're not anticipating, but in your situation, you may not be able to pay it. Beyonce, I think she'll be all right. Okay, if she doesn't win at tax court. However, like I said, you may not be able to wear those same shoes. If that is the case, I would strongly recommend that you do go ahead and book that tax relief evaluation with me, right? On the call, make sure you have your latest notices, any questions, because we're going to spend that 45 minutes devoted to your case. And when you get off, you're going to have a game plan for how you're going to tackle that debt. Now, remember, if you talk to me, it's not free, but I promise you that you'll have that game plan. And then during that time, we'll see if we're a good fit to work with each other. Okay. Now, if the shoe doesn't fit, but you think this was a really cool episode, do me a favor. Share this with your friends, family, Facebook wall, LinkedIn, because I'm still on my mission to fill the tax literacy gap one taxpayer at a time. And even if I'm not your cup of tea, I may be the help that somebody else needs, because back taxes don't have to ruin your life. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family, because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.